Hey everyone, welcome back to the channel. Today, we're going to explore a key economic principle that every investor should be familiar with, the diminishing marginal utility effect. What exactly does this mean? In simple terms, it's the idea that as you consume more of a good, the satisfaction or utility you get from each additional unit tends to decrease. Let's break this down with a quick example. Imagine you're super thirsty. The first glass of water you have is incredibly satisfying, it really quenches your thirst. But by the time you're on your second or third glass, that satisfaction might start to fade. In fact, those extra glasses might bring you only a fraction of the joy that the first one did. This concept isn't just important for consumers, it's also vital for investors. Understanding how utility diminishes can lead to smarter investment choices. For example, when looking at different assets, it's crucial to think not just about potential returns, but also about how much satisfaction each investment brings relative to its cost. Just like with water, pouring all your money into one investment could lead to diminishing returns over time. Now, let's connect this to investment strategies. One practical way to apply the diminishing marginal utility effect is through diversification. By spreading your investments across various asset classes like stocks, bonds, and real estate, you can enhance your overall satisfaction and reduce risk. This way, you won't be overly dependent on a single asset that might give you diminishing returns as you invest more. Also, remember that this principle can serve as a reminder to avoid overconsumption in your portfolio. Just like with water, more isn't always better. Focusing too much on one type of investment can throw off your balance and make you more vulnerable during market dips. Lastly, keep in mind that everyone's financial goals are unique. What brings satisfaction to one investor may not work for another. That's why it's crucial to evaluate your own preferences and risk tolerance when building your investment strategy. Thanks for tuning in. If you found this discussion on the diminishing marginal utility effect helpful, please give us a like and subscribe for more insights on economics and investing. See you next time.